Not every stock market drop is the end of the world, but some can freeze your wealth for an entire generation. The health of banks and the speed of government support determine whether you will have a quick recovery or a lost decade. The financial market often gives scares that seem like the end of times. However, history shows that not every crash is created equal. There are three fundamental categories that separate a passing scare from a systemic disaster. Purely technical events are like summer storms, fast and intense. A classic example occurred in the late 1980s, when the American market plunged about 1/5 of its value in just 24 hours, even with this sharp drop. The engine of the economy was intact, and everything returned to normal in about 2 years. Another recent scare happened in early 2020, with the fastest drop in history, exceeding 1/3 of market value in less than a month. This time, the recovery was record-breaking. The main American index took only 5 months to return. To the top, this happened because the Fed acted as a shield, buying even high-risk debt securities to keep money circulating. Cyclical crashes are like hurricanes. The cleanup is much slower. At the turn of the millennium, the technology bubble burst and the sector took about a decade and a half to fully recover. In these crises, the problem is excess optimism in companies without real profit. But banks generally remain healthy. The real danger lies in systemic crashes, which function like a true financial ice age. According to historical S&P 500 data compiled by the Fed, in the greatest crisis of the last century, the market plunged almost 90% and took about a quarter of a century to recover its original value. The maximum warning signal is when the banking system breaks, FDIC. Data show that in the 1930s, over 9,000 American banks ceased to exist. When credit disappears, the economy stops, unemployment hits about 1 in 4 workers, and money loses value. Another extreme example happened in Japan, where the market fell more than 80% and took about 3.5 decades to surpass the previous peak. To know if we are in danger today, don't just look at prices, but at the health of the big banks. If the banks are safe and the Fed is ready to act, a 30% drop could be the best buying opportunity of your life, unlike the deceptive stability we are currently seeing in the housing sector.
Welcome to the rational frontier.
UK house prices rose just over 2% on paper in the last 12 months, while CPIH inflation hit around 3.6%. That means real purchasing power in property actually went backwards, a quiet kind of decline that doesn't make headlines, as the purchasing power of the money trapped in bricks has decreased. According to the Yopa Housing Market Affordability Review, cited in a report from the UK's Office for National Statistics, UK house price index data adjusted for CPIH inflation show that prices have returned to levels from about a decade and a half ago. For the first time in years, wage growth is outpacing inflation and house price appreciation. Affordability for first-time buyers has reached the best level in 10 years due to this shift. The income commitment to mortgages has fallen to about 1/3 of salary, far from the nearly 50% seen in the late 1980s. The biggest current obstacle is not the monthly payment, but the initial deposit of approximately £27,000. Roughly 2 in 5 first-time buyers still need help from family, the so-called bank of mum and dad, to cover the average £27,000 deposit. In the rental sector, rents rose about 4% in the last year. New legislation expected before the end of the semester will limit rent increases to once per year. London is now the only region where property price growth is effectively moving backwards. While the south cools, regions in the north show the highest increases, reaching nearly 8% in some areas. The market is experiencing a rebalancing, with investors and residents seeking better returns outside expensive major centers. The old rule that the capital leads and the rest of the country follows is losing strength in the face of new regional data, a shift in control that is also happening in the digital world, where your most personal data is the new currency. Imagine opening your favorite app and discovering that overnight the rules of the game changed, and now even the dilation of your pupil is worth money to the new owners. The recent restructuring of TikTok in the US has transformed the platform into a domestic surveillance machine focused on biometric capture. What was an issue of international security turned into a billion-dollar business between political allies, where the currency of exchange is your absolute privacy. According to the company's public record, about 170 million American users were required to accept a new mandatory terms of service to continue using the app. The operation marked the birth of a new company under the control of a group of American investors. The deal was closed for approximately $14 billion, a value considered a bargain compared to previous market valuations. To give an idea of the discount, Elon Musk paid more than 3 times that amount for Twitter, which has about a quarter of this platform's user base. Although the former Chinese owner still holds about 1 in 5 shares of the company, control of sensitive functions has passed to local hands. A giant in technology and data management, Oracle, now oversees the algorithm that decides what you watch. The change did not come without flaws. Right at the start, users lost the ability to send certain words via direct message, which the company called a technical error. Reports indicate that videos on sensitive social topics stopped receiving views or were hidden from the public. A report from the newspaper Le Monde, based on technical analysis, indicates that some apps collect location data with very high granularity. The new policy now allows GPS tracking, with millimeter precision, identifying even the floor where you are in a building. If you use camera filters, the app can monitor your facial micro-expressions to measure your emotional reaction to each post. According to Wired, the new terms give the company a permanent, free license to use your image and voice to train artificial intelligence. This includes not only what you post, but even drafts of videos you recorded and decided never to publish. TikTok states in its privacy policy that it collects information such as device ID, approximate location, and app activity, and offers tools to request a copy of the data it processes. There are technical indications that the app's internal browser can monitor typing patterns on external pages. If this is true, shouldn't it at least generate public debate? Research from Cornell University reveals that many third-party libraries and apps collect a variety of user interactions without total clarity in privacy policies. Pew Research Center surveys show that 1 in 4 users uninstall an app after discovering it collects personal data they do not wish to share. What was sold as a national security measure ended up becoming a transfer of custody of your data to a new surveillance group, and just as apps mask their true intent, financial products often hide their true costs under the guise of expert advice. I recently watched an influencer I used to follow closely push BMOE's ZQT as the perfect all-in-one solution. Honestly, it was disappointing to see solid analysis replaced by what felt like a paid promotion. ZQT is a fund of funds that charges fees too simply by 6 other ETFs from its own management institution. In the end, what they call a complete strategy is just automation that delivers average market returns while locking up your capital. I understand the outrage in the comments. No one likes to feel that trust has been priced by an affiliate link. They are selling passivity as a virtue, but charging to do what you could do with a few clicks is the opposite of helping the investor. The video promotes global diversification that, in practice, ignores major opportunities outside the traditional axis. Don't be taken in by the "I've invested my own money in this" line when sponsorship is part of the picture. The incentives shift, and that changes everything. For me, delegating total control of your assets for a fixed fee might seem comfortable. But it's the shortest path to financial mediocrity. According to the fund composition disclosed by BMO on its official website, ZQT concentrates almost 3 out of every $4 exclusively in North America. Approximately half of the entire fund is composed solely of the 500 largest US companies. Exposure to developing nations is negligible, not reaching 1 in every $12 invested. Its real profitability depends on just 2 sectors, technology and banks, which dominate over 40% of the portfolio. According to the ETF prospectus available on BMO's website, the investor pays 20 basis points in total cost for the manager to perform an automatic rebalancing every 3 months. The suggested core and satellite strategy keeps 95% of your capital under the absolute control of the sponsoring institution. Ultimately, we all make mistakes, and it's understandable that creators accept sponsorships when financial survival is at stake. The market is tough and money talks, but our role here is to separate genuine content from disguised advertising. We don't need cancellation. Just more criticism to understand what we are really buying. Real diversification requires you to understand what you own, rather than just accepting an off-the-shelf solution. Let's continue learning together to identify where education ends and commercial interest begins. Starting with how to build a real safety net that doesn't rely on expensive middlemen.
To track updates on market evolution and convergence metrics, follow Rational Frontier.